Hey there and good afternoon, E-mini Minders. This is Trader Tim from over at eminimind.com doing a Monday market analysis video to kick off this week, the 16th of, what month is it here? September. And we are finally reaching that point where we have the September FOMC meeting announcement. And that's important because typically this kind of gets the ball rolling for some better trading and a really good sort of direction that the markets will go into the end of the year. So we've got kind of the middle of September. We'll get this meeting knocked out on Wednesday, and then we have October, November to about the middle of December before things start to slow down into the new year. So this is a really good time to be trading, and the fact that we're trading near all-time highs in the ES, and if we take a peek at the S&P, we can see pretty much the same situation here on across the board, except for the Russell. So S&P, let's actually look at the ETF, the Dow, and then the Russell well off its highs, but then the Nasdaq also, just like the Dow and the S&P, close to all-time highs. So whether we double top up here, there's a couple scenarios that can happen. Now, Fed's not likely to raise rates. Chance that they may again lower rates, which just seems absurd in this kind of economy where things are going pretty strong. But whatever they end up doing, it's going to be important to watch the reaction Wednesday. And then Thursday is typically like the start of some awesome trending, great environments to be trading in. So with the, go back to the SPX, a couple of scenarios that can happen up here, and we're at this junction where we can, officially double top. And what would make that occur is coming down and breaking a swing low, which at this point, let's actually go over to the ES chart so we can get some exact numbers. The 29.57.25 would be the swing low that would confirm at least a short-term double top. And then if we come down and break the swing low back here, more of the major swing low, which is down at 28.20, that would be sort of the big monster. Here we go, hang on for the ride. That's this tail down here, and we should see a much bigger pullback to something like 23.75 and then beyond. But if we just push into new highs here, and if the reaction off of the FOMC meeting announcement is positive, regardless of what they end up doing, cutting rates or not, then we have room to, I would think, quickly go to this 30.58. That's the target of this 50% retracement that I have drawn that we've sort of just come up close to but haven't been able to get to it. The second target beyond that would be much, much further out, upwards of 3,200. So, going from where we're at now, we'll just say 3,000 up to 3,200 would be, the bullish scenario into the end of the year. And going from 3,000 down to, 2740, I would say even lower than that, because a lot of times the market will fall much faster than it will rise. So I think we've got some good opportunities in the next couple of months for some big swings. Whether it's up or down, we'll see what the reaction is on Wednesday. I would kind of expect tomorrow to be a little bit lackluster. We'll be doing a live trading session, so we can discuss things and I can answer questions, but not usually expecting a whole lot on the Tuesday before the Fed meeting. And today was very much indicative of that. I've got the high and the low, the first 30-minute range marked. And I mean, we're pretty much just kind of moved sideways in that 10-point range all day. So, um, expecting a little bit more of that tomorrow, but then Thursday, expecting things to really turn around. So we've got a little ways to go just to come up and knock out this 30.2950 to put in a new high. And if we can close above that, not just break into it and maybe put a inverted hammer up there, but we need to actually break above it and close above it. That would be a very, very bullish sign. I did want to talk about a couple of swing trades just because I've been getting more comments and questions about that. So here's Home Depot, a stock that I really like to swing trade on a daily chart. And we had this nice pullback back here to this kind of dragonfly doji or hammer, whatever you want to call it. But I don't execute necessarily right at 50% on the daily chart. I might draw one up just to get an idea, but I find that letting the market pull back and then figuring out where my signal bar would be and using a 50% to get an idea. Okay, well, 222 is right around that halfway back point, so let me look for a signal bar around that area. And then in this case, we got the gap up coming off of the pullback, and that is a gap up that you want to be a buyer of. If the market's going down, 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 and then we gap up, that's a gap to get on board early, right at the start of the day. And so this hammer kind of signaling, okay, market turning at or near a 50%, and then jumping in on that little gap up, and then just trailing your stop underneath the swing lows as we keep kind of pushing up, move sideways, push up, kind of move sideways or pull back. And so currently just keeping the stop underneath this hammer here up at 229.50. So for these bigger stocks, like if it's above $200, using a 20-30 cent stop is a little bit tight, but you could go as much as 50 cents, but just kind of keeping your stop below that swing low. Now, for those that are trading options, this is where it gets a little bit you get a little bit less advantage if you're trading this way with an option, because if you were waiting for the market to break out like this or gap up, well, now that option is priced more, and if you're trying to get one at the money or as close to as possible, you're going to be paying a premium. And then as it moves up and you're sitting on that option, the price has kind of gone sideways here for about 5 days. Well, the option price is going to be deflating over those 5 days with the time decay. So you have to get a little bit clever with the options. You can come down here and look at trying to get in the option as it pulls back to support, and maybe it's still going down, but you are going to be typically losing less versus paying more by waiting for the gap up. So by getting in, somewhere down here at support and having it go against you, it's pretty easy to just close out of the position if it starts to break down. But if you get into the option on the gap up, I mean, the difference between, let's just say, a 221 and a 226, let's say you were buying a strike of 225, I mean, that could be a big price difference. And especially if you're buying a directional option as it's going in that direction. So if you're buying a call and the option has momentum and is going up, that's going to be baked in extra premium that you're going to be paying. So you need to, or I've found when I trade options, I need to be a little bit more contrarian and be buying at sort of a not very appealing time, not when it's very clear with a hammer at a reversal level. Kind of basically got to be buying down towards the bottom of the tail and as the market's going down to get a much better price so that when it does go up, I'm already in it. I can take advantage of the gap and then let it go. So if you have the bankroll to be able to trade the underlying stock, even if you're only risking a couple $100 and on a bigger stock like this, you might only be trading 50 shares. There can be a lot of benefits because you can exit at a lot of different places. You don't want to exit one share at a time, but if you had 40 shares, you could exit 10 shares at a time at various levels as the price goes your way. And if it does move sideways, you're not losing that time decay. So that's just one way that I look at my swing trades. In these situations where we gap up, you can put your stop right underneath that gap bar. You could also put it, and this is kind of a strategy to reduce your risk as well, or not reduce your risk, but lower the number of shares that you're purchasing if you have a smaller bankroll. If you put it below the close of the prior day, or even the low of the prior day, that's going to widen the distance between your entry and your stop. And so if you wanted to risk $100 and that distance is $5, well, you buy 20 shares. If that distance is $10, well, now you're only buying 10 shares. So obviously the market would have to move further to give you a larger, kind of give you the same gain. It would have to go further as if you had twice as many shares, but you're reducing the number of shares, the capital that would be required to hold those shares. So just something to think about. That's the nice thing about swing trading. You can have a little bit more wiggle room. We're not so tied to these minute stop levels. So it is a nice pairing to have an arsenal of swing trades and then an arsenal of day trading as well. So just something to think about. I know not everyone's swing trading, but it can be helpful at times to have both of those, or at least be conscious of what some individual stocks like the FANG stocks and the likes are doing. So I hope everyone has a great week. I really hope we get some kind of directional trading coming off of this FOMC meeting. The month of August was kind of wacky as usual, and it's about time the markets are starting to look a little bit better. And I think at the end of this week, they'll really be looking a lot better. So best of luck out there. Stay safe. There's no need to make your home run in one day. So definitely don't take excessive risks on Wednesday because you can be knocked out of the markets in an instant, and better to have the bankroll to be able to continue trading for the long term than trying to risk it all and have a big loser that knocks you out so that you can't trade anymore. So hope everyone has a great week. If you have questions, feel free to leave them below, and we'll talk to some of you in the morning at eminimind.com/VIP is where you can get the info on the Tuesday trading room. Thanks, everyone.